China became a member of the World Trade Organization, namely WTO, in December 2001, and committed to fully opening up its banking sector to foreign firms by December 2006. This marked the beginning of the fourth stage. With Chinese economy integrating into a world economy, China's banking sector is confronted with many unprecedented challenges and opportunities, and required to adopt a number of effective measures to promote the steady development of banking. The reform since then has been focused on developing a sound and robust financial system to guard against and dissolve financial risks, cleaning up the balance sheets of banks, improving their ownership structures, strengthening their corporate governance, developing market infrastructure, enhancing supervisory capacity, and further opening up the financial industries. Beginning in the late 1990s, still further changes in the financial system occurred. The Big Four had accumulated enormous non-performing loans as a result of their early policy-directed lending. So, the government undertook a series of actions to address this problem. The actions taken over several years sufficiently improved the financial condition of the Big Four for them to go public. Since the access to WTO, China has released its controls on capital flows, institutional investor programs, that is QFII, Qualified Foreign Institutional Investor, was introduced in December 2002, and a Qualified Domestic Institutional Investor, known as QDII, was introduced in April 2006. Those two programs set quotas on portfolio inflows and outflows, respectively. Till August 2016, China had granted QFII quotas of $81 billion and $90 billion in QDII quotas. The two programs provide very important channels to capital flows and becoming more and more important. Through more than 3 decades of reforms, China has developed a diversified and competitive financial system. In addition to the central bank, China has 3 policy banks, 6 largest state-controlled commercial banks, 12 joint equity commercial banks, operating nationwide, more than 100 commercial banks, and rural cooperative banks. The non-bank financial institutions mainly consisted of as trust and investment companies, security firms, finance firms, insurance firms, asset management companies, and so on, which played a more and more important role in financial system. At the same time, financial markets also experienced a rapid development with the market reforms and liberalization of national economy. In the early 1990s, 2 stock exchanges were established, one in Shanghai and the other in Shenzhen. Correspondingly, China Securities Regulatory Commission was set up in October 1992 as the national regulatory authority in security markets. In 1994, Unified Interbank Foreign Exchange Market was set up. In 1996, a Unified Interbank Money Market was established. In addition to the 2 stock exchanges, China has 3 commodity futures exchange, namely Shanghai Futures Exchange, Zhengzhou Commodity Exchange, and Dalian Commodity Exchange, mainly on agricultural products and industrial products. The commodity futures market started almost simultaneously with the stock market. In October 1990, as the first commodity futures market in China, Zhengzhou Grain Wholesale Market introduced its first futures contract. From 1994 onwards, the market has undergone a consolidation process. Today, the market has 3 commodity exchanges and 1 financial futures exchange. China Financial Futures Exchange was founded in September 2006 and trades on stock index futures and T-bond futures. Meanwhile, a multi-tier trading market for bonds has taken shape in China, including on-exchange bond market, interbank bond market, and over-the-counter market. In July 1981, the issuance of T-bonds, of Treasury bonds, was resumed in China, and 6 years later, a secondary market for Treasury bonds was established, and thereafter it has been growing rapidly. The interbank bond market is the most important platform for blocking trading of bonds between financial institutions, as well as for open market operations by the People's Bank of China. The major participants in the interbank bond market include the People's Bank of China, commercial banks, securities companies, insurance companies, securities investment funds, and so on. The traded instruments include Treasury bonds, financial bonds, corporate bonds, convertible bonds, short-term corporate notes, and international bonds. The exchange-traded bond market refers to the bond markets on the two domestic stock exchanges. It is an order-driven market where the major participants are securities companies, insurance companies, securities investment funds, trust and investment companies, other non-financial institutions, and individual investors. Commercial banks have no access to this exchange-traded bond market. China's securities markets are playing an increasingly important role in financing resources and promoting economic growth. In the early 1990s, the market was only supposed to serve large state-owned enterprises. With the adoption of modern enterprises system in 1995, many state-owned enterprises were reorganized into shareholding companies since the late 1990s. More and more private companies accessed to the securities markets. Nowadays, China's security markets are playing at least 4 roles. First, it plays an important role in resources allocation by raising a great amount of capital for corporations. Secondly, it facilitates a number of companies to grow larger and stronger by means of restructurings. Most listed companies have turned into industry leaders. In particular, these companies have largely improved their corporate governance, risk control, and corporate culture. Thirdly, security markets provide diversified investment instruments and contribute to the growth of financial services industry. Now, the number of investment products has been multiplied and diversified, which provides differentiated investment choices for investors. In the meantime, the growth of securities markets contributes to banking reform, financial infrastructures build-up, and service improvement. Lastly, with increasing international cooperation and opening up to the outside, financial markets provide an important channel for foreign capital to be invested in China. There are a variety of financial products available in the security markets, such as A shares, B shares, security investment funds, treasury bonds, corporate bonds, commodity and financial futures, and so on. We'll illustrate the most important types of financial products one by one. First, A shares. A shares refer to the common shares issued by companies registered in China's mainland and traded by domestic entities or retail investors in Chinese currency. B shares are issued by China registered joint venture companies listed on Chinese stock exchanges and denominated in RMB. However, B shares are subscribed and traded in US dollar at Shanghai Stock Exchange or in Hong Kong dollar at Shenzhen Stock Exchange. A shares are basically limited to domestic investors, while B shares are designed for foreigners. Furthermore, some Chinese companies are cross-listed on overseas exchanges, and their shares listed are named after the exchanges. For instance, H shares are shares listed on the Hong Kong Stock Exchange, while N shares are on the New York Stock Exchange. Security investment funds are pools of money that are managed by a securities investment company. They offer investors a variety of goals depending on the fund and its investment charter. Security investment funds can be divided into an open-end fund and a closed-end fund. An open-end fund can be freely sold and repurchased by investors based on the closing market value for listed public securities. While a closed-end fund has no regular redemption date and can only be redeemed in limited circumstances,